All right, greetings friends, Weston Nakamura from across the spread in Tokyo. So today I'm going to talk about the most dangerous market in the world, the Japanese government bond markets, or JGBs, namely long-dated JGBs. But before I go any further, let me just show you a recent clip from Bloomberg News of a guy whose name is Guy Johnson, from Bloomberg TV in London, discussing the JGB markets.
Wednesday morning, good morning. So I spent the morning thinking about left-hand side tail risk. Who would have had the Japanese 40-year on their agenda as being something they needed to think about?
Yeah, thanks for doing the space. Is there a catalyst or a big event for risk assets?
Yeah, I'm going to give you three right now. Today, at 12:30 p.m., where we get results for a 40-year JGB auction. And let's see how those results come out. Given these massive rises, these spikes into all-time record highs in long-end JGB yields, could be a volatile event in either direction. 12:30 p.m. Japan times, May 30th and June 17th. Those are the next foreseeable ones.
And here we are this morning with that long-end bond that we've rarely talked about ever. I can't remember a time in my career, and my career is quite long, focusing on this, Anna. And here we are, the Japanese bond market.
Yeah.
Who'd have thought it?
You really have to watch what's happening with the JGB market at the long end to really get an indication of what sovereign bond demand looks like in the global picture. You have to look at Japan in order to understand US Treasuries, US Treasury treatment and behavior and investor sentiment and government and central bank reactions.
And here we are, the Japanese bond market.
Yeah.
Who'd have thought it? Long duration Japanese bonds, largely owned by the BOJ. And this is the epicenter of the action this morning.
I don't understand why people are making such a massive deal about long-end U.S. Treasury yields that are currently rising. So last week, they weren't even at year-to-date highs where JGB yields are hitting all-time record highs.
Long duration Japanese bonds, largely owned by the BOJ, the Japanese bond market.
Yeah.
Who'd have thought it?
The Japanese government bond market. Who would have thought? Okay. So that's not just embarrassing, but it actually is kind of like a perfect example of what makes the JGB market so dangerous, at least in small part, okay? Like, basically any market that is big enough to impact and move major global macro markets, including or especially US Treasuries, but then at the same time has somehow, escaped the attention or just the basic, acknowledgement of its existence across like vast swaths of market participants and observers and commentators and media, such that it can suddenly just pop up out of nowhere and be at the epicenter of global market focus on any given day. That is a dangerous market, okay? And just one more thing about this guy, okay? If this guy, who is openly admitting that long-end JGBs have never been on his radar throughout his very long career, but is now saying that they are on his radar, then good God, we all need to be at least ahead of that guy in terms of our own awareness of what's happening with long-end JGBs, okay? Now, I know that like some people out there, or a lot of voices out there probably are mentioning the JGB markets as of late, okay? But to be completely honest, from my standpoint at least, there's like very, very few actually substantive, in-depth insights on this topic, okay? Like people mention it, great, you mentioned it. Watch JGBs, all right, glad you have your eyes on it. But what about JGBs? And there's no follow-through, okay? So that's what I'm here to do, okay? Today, I'm going to make the case for not just watch JGBs, but like the title suggests, I'm going to make the case for why I believe the JGB market is indeed the world's most dangerous market, okay? And how it's impacting other major global markets, how we got to this point in terms of having the JGB market become the world's most dangerous market, and that's obviously via the Bank of Japan and the Ministry of Finance, and what lies ahead, because there are some very significant catalysts that lie ahead in the immediate term, in this month of June, okay? and for years going forward as well. So first things first. So when I use the phrase or the term, the world's most dangerous market as it relates to the Japanese government bond market, this is not hyperbole by any means. Okay, those of you who have followed me in the past, first of all, you know that I obviously closely monitor and make commentary analysis on the JGB markets and their broader global market impact, right? But I've never characterized the JGB markets or any market as such. But the reason I'm doing that now is because this time is different. This moment is different. We are currently at a major inflection point where this already dangerous market is hitting a dangerous moment, okay? So when I say that it's the most dangerous market, I am being very purposeful with my word choice. And in doing so, I'm going to lay out specific definitions and characteristics of what makes a market dangerous, just so that we're all on the same page and just to be absolutely clear, okay? So, what makes a market dangerous, generally speaking? In my view, a dangerous market is one that exhibits the following characteristic. Basically, you have extreme levels of mispricing, you have severely damaged market functionality or dysfunction. A dangerous market is one that is broadly interconnected with other markets, cross-regional, cross-asset. A dangerous market is one in which there's complacency by market participants, or there's just an absence of awareness by both direct market participants and by the broader market community as a whole. And then also in terms of like purposeful, hidden sort of conditions or corruption, like the Enrons and stuff like that. That obviously doesn't apply to this current case, but that would fall kind of under that same category of a dangerous market. A dangerous market is one that is past the point of being able to fix or reverse the damage that it's undergoing, but before the actual real damage begins, right? Like already at some point of no return. A dangerous market is one that has non-green and red blinking ticker financial market implications, societal implications that are deep and that are long-lasting. And then finally, one that has a major trend shift or a reversal or some sort of like fundamental change or something, or like disruption to any and all of the above aforementioned. Okay? Now, just note that a market doesn't need to like exhibit every single one of these points in order to be a dangerous one and cause like wide-scale destruction, like Asia currency crisis or the dot-com bubble, subprime housing, right? They all shared, albeit to differing degrees, these characteristics, okay? And they each certainly turned out to be dangerous markets. That said, this list is like a perfectly apt checklist or description of JGB market characteristics today, okay? And makes for JGBs to be the most dangerous of all. Now, let me kind of further elaborate a little bit more on a few of these features of what makes a market dangerous, okay? So in terms of like extreme levels of asset mispricing, so that's dangerous when it's in the form of like speculative asset bubbles being driven at the hands of market forces that have gone crazy, right? But it's far more dangerous when this extreme mispricing occurs at the hands of a non-economic actor and like artificial suppression of price discovery or just like outright elimination of free market forces. That is far more dangerous than when market forces alone are exhibiting, you know, ridiculous asset prices or mispricing, okay? In terms of the interconnection or like contagion aspect of it, so like that isn't just something that just suddenly unveils itself upon like a market event, right? Like contagion risk or something like that, right? But it's also like something that has been directly or indirectly impacting other markets like all along and had just gone unnoticed, okay? Which then itself is like the bridge to the next point, the absence of awareness by broader market participants, okay? As far as market participants, the direct market participants in said dangerous markets. So a large part of what makes it dangerous is this aspect of market functionality or market dysfunction, particularly if and when these market participants themselves are totally unaware of or underestimate the conditions of market functionality. Okay, but that said, markets that are in a state of like severe dysfunction, they're just dangerous, period, to operate in for any market participant, regardless of that participant's like awareness of it being a non-functioning market. Okay, so are JGBs, are they mispriced? Are they structurally dysfunctional? Are they being widely ignored by global market participants while impacting other major markets like US Treasuries? Are JGBs currently undergoing a major generational change that is experimental and without any precedence, with both domestic and worldwide implications? Well, you can decide for yourself after this, okay? But here's how I would put it. The JGB market is the largest bubble probably in financial market history, but certainly as of current outstanding, the largest bubble in markets, modern markets, okay? And it is a bubble that was inflated not by market forces, but by policy, and is currently undergoing an attempted controlled deflation of that ridiculous bubble, orchestrated, again, by a tiny handful of non-market policy officials. And they're operating in a severely damaged market structure that they themselves had damaged as a side effect of their presence in said market and this blowing up of the JGB market bubble. And they're working against opposing market and economic realities of like extremely consequential trade-offs, is lose-lose or lose-less situations, right? And those choices themselves are luxuries that are dissipating, okay? And also, just to continue on, like just to hone in on these definitions, when I say largest bubble, okay, how I'm defining large is basically the level of the mispricing as well as just the sheer notional size of the asset bubble, okay? So, are JGBs mispriced? Well, if the risk-free United States government has to pay 4.5% or 5% to borrow for a decade, that's more than triple what the world's most indebted government has to pay in borrowing costs for a decade. Okay? So, yeah, JGBs are severely overpriced, even though long-end JGBs are hitting record highs in their yields as of late. They are still below risk-free US Treasuries as well as the other DM bond markets, despite having a horrendously more atrocious fiscal situation, okay? Now, as for size, okay? So, at the height of the US housing bubble, like 2006 to 2007, somewhere around there, right? Total value of subprime mortgages estimates are like somewhere around like $1.5 trillion, okay? Subprime CDO derivatives on top of that is like another, 1 trillion or so in notional value. So like, I mean, it's impossible to tell exactly, but more or less, we'll just call it like, what, $2 to $3 trillion would be the size of that asset bubble. And that was certainly a massive and massively destructive bubble. Yes, it was. Well, the size of the Japanese government bond market is 1.128 quadrillion yen, or 1,128 trillion yen, or about $7.5 trillion of outstanding JGBs, okay? Which makes it the largest sovereign bond market outside of the United States Treasury market. Japanese government bonds are the sovereign debt of the world's now fourth largest economy, Japan, but also of the world's most indebted nation by far, with approximately 250% of debt to GDP. Okay? Japan is the world's largest foreign fixed income investor, including being the largest foreign creditor to the risk-free United States Treasury. In other words, Japan lends the most and is simultaneously the most indebted country in the world. So interconnected contagion risk? Yeah. Okay? Because if JGBs, if they become like truly deemed as uninvestable by markets, well then the world's largest foreign creditor to the United States being deemed uninvestable is going to hit this highly indebted yet largest U.S. foreign creditor nation's holdings, US Treasuries. Okay? The direct fundamental impact there. Okay, so every time you hear about someone who doesn't want to own US Treasuries due to the fiscal health of the United States, and these are comments that are made often by major institutional investors, the professionals, okay, that's just yet another voice that represents the unawareness crowd of the JGB market situation. Because chronologically speaking, if it really is sovereign credit risk that you're basing your capital allocations on or avoiding, right? It's not US Treasuries being at risk of massive volatility because of the fiscal state of the sovereign US, right? The reason that US Treasury holdings would be at risk of volatility is because of the fiscal state of its largest foreign creditor, Japan. Okay? Sure, someday maybe down the line, US Treasury markets might implode due to poor US fiscal health, but the US Treasury market doesn't get destroyed from some foreign buyer's strike while its largest foreign buyers' domestic markets, JGBs, are still somehow standing and have value, okay? That's not the order of events. It goes JGBs go down first, then everyone else thereafter, if it really is going to be some cascade of actual DM sovereign defaults, okay? And no, that is not what I'm calling for, nor what is currently underway right now, all right? And I'll get to that in a moment. But who does this matter to? Everybody. Everybody everywhere who is involved with markets, okay? Here's a notable example. So, recently, there has been this singular obsession level of focus, if not outright panic, over the long end of the US Treasury curve and how long-dated US yields are just surging to alarming territory in an alarming manner, right? Okay. Calm down. 30-year US Treasuries are basically just hovering around their year-to-date highs, okay? And actually, Treasuries spent most of the bulk of the year in a declining trend, if anything, okay? 30-year US Treasuries, they're not even at their 2023 highs, okay? So where's the emergency fire that's going on? You want to see a 30-year bond yield that's actually been on a path of sustained surging? JGB 30s. Take a look at 30-year JGB yields that started the year more than a full 1% lower and then ripped 50 basis points higher within a span of a week in March. This is all pre-Liberation Day, okay? And then, joined into the global yield volatility in the immediate aftermath of Liberation Day. And then it just surged ever higher to all-time record highs. 30-year and 40-year JGBs are hitting all-time record highs, and they're doing so in an extremely rapid and almost one-way manner. So if you want to panic about long-dated US Treasury yields rising, fine, okay? But the question should be, why are they higher? They're higher, they're rising because long-dated JGB yields are driving US Treasury yields higher. Okay? Typically, long-dated JGB yields don't just blindly follow whatever, the US Treasury yield counterpart is doing, unlike other DM peer bond markets, okay? The JGB long end doesn't correlate with the others, largely because JGBs in Japan and its insane levels of debt are just on a completely different planet, as well as what controls JGB markets, which is mostly the heavy-handed Bank of Japan and its policy. This was the case going into 2025, where you have JGB yields at the long end, basically in terms of price action and behavior, having nothing to do with 30-year yields on US Treasuries. But then, from March, JGB long end yields, not only did they begin to blow out to the upside, but when they started to do so, that's when they became highly correlated with US Treasury yields. And that tight correlation remains, especially over the month of May. JGB yields have been driving US Treasury yields on a day-to-day basis in both directions. And look, you don't need to take my word for it. Okay, you don't take it from me. This is a clip from a recent interview with United States Treasury Secretary Scott Bessent, who very correctly says the US Treasury yield move to the upside is not due to matters of Congress or anything US derived for that matter, because this is a global bond yield move.
The bond market hasn't necessarily stood up and applauded with what they've seen out of Congress. Is the bond market wrong?
Well, I think the notion that in any movements in the bond market are being driven by the action of Congress is what's wrong. First of all, this has been a global phenomenon that the Japanese yields have moved substantially, German, UK, and David, if we go back and look, since either the beginning of the year or January 20th, when the Trump administration came in, the U.S. 10-year is the only yield that is lower today. So, all yields are up. And again, I think that was a coincident indicator. The market's very good at latching on to a story. So, yeah, I'm not particularly worried about what the market is thinking, because, on the other hand, what the market also could be thinking is that this bill is going to create growth.
That is Scott Bessent, the market veteran speaking, not Scott Bessent, the chief U.S. bond salesman, okay? And the reason I can say this is because, first of all, what is he saying? Okay, all he's saying is he's simply stating indisputable market facts about what U.S. Treasury yields and other sovereign yields have done year to date, okay? But the other reason that I can confidently say that this is not Scott Bessent, the chief U.S. bond salesman speaking, is because of the very last line that I purposely left into that clip that I included.
On the other hand, what the market also could be thinking is that this bill is going to create growth.
That is Scott Bessent being the bond salesman. But everything prior to that are just the facts, okay? So, if Secretary Bessent is saying, A, that U.S. yields are not rising because of U.S.-related reasons, and explicitly points to Japan, and B, if the 10-year U.S. Treasury yield is the most important market price that he monitors and sets policy to, what those two things in combination, what that essentially means is that, according to Secretary Bessent, U.S. Treasury Department policy is being indirectly influenced by developments out of Japan and the JGB market. Okay? So that's yet another reason why, among many others, why the JGB market is the world's most dangerous market. Okay? Not just because it has an enormously wide-scale amount of direct and indirect influence and impact across the world, be it markets or policy, okay, not just because of that, but also because of how overlooked and how misunderstood and underestimated its ripple effects are. Okay? And again, Bloomberg TV putting this on display. That guy who's interviewing Bessent, the beginning of the clip, he asks this question: U.S. Treasury markets aren't applauding Congress, or the markets are wrong. Dude, U.S. Treasury yields at the long end are not moving to Congress or just U.S. internal reasons alone, you idiot. Okay? So, in light of that kind of stupidity and a complete absence of patient zero of everything, which are JGB yields at the long end, which are the most dangerous markets in the world currently, facing a very dangerous moment, this is going to be an in-depth explainer and an analysis on the current state of affairs around what I feel is the foremost consequential, dangerous, and dangerously overlooked and misunderstood market in global macro today, long-dated Japanese government bonds. So let's just go through the tumultuous month of May that Scott Bessent is referring to in that interview, okay? So as I showed, long-end JGB yields, they had already been on a relentless and precipitous rise from March, but in May, this is what we have. In the front half of the month of May, 30-year JGB yields are they're ripping higher and they're closing in on breaking through a very key level of 3% for the first time ever. But they're being capped from doing so at first. Okay, you can clearly see that there's an upside cap on yields at 3% on 30-year JGBs. Okay, and this part of the move, this is actually key to understand this background. So first of all, it's relatively orderly of a move, right? It's not like a hyper volatile move, right, to the upside, and it's obeying this like 3% ceiling, right? But some of this is occurring on the backdrop of an ongoing and intensifying political debate that's happening in Japan, still underway, okay? Because you have July upper house elections looming ahead in Japan, and Prime Minister Ishiba and his dogshit approval ratings continue their one-way slide downwards that began and peaked like the moment that he took office in October, at which point he very stupidly misread the electorate by calling for an immediate snap election, resulted in his ruling LDP party to lose its majority. It was a very stunning defeat, or at least to them, it was a very stunning defeat, okay? But basically, inflation in Japan lingers. It's pissing people off. Specifically, food inflation continues to rise in Japan. And so as that's been happening the last few months, really, members of both the LDP and its coalition party, as well as opposition parties, have been calling for like various forms of fiscal stimulus measures, you know, to help the household and living costs and all that, right? And those kind of fiscal stimulus measures are starting to get louder and louder. And these are like measures that range from stimulus checks at one point to discussions about dropping consumption taxes down to 0% and whatnot. All that basically just means deficit financing, or in other words, just more JGB supply to be issued, right? And Prime Minister Ishiba, he was originally on board with like fiscal stimulus measures like earlier this year. Okay, but then he started to like back down, and now he outright opposes consumption tax cuts and any sort of fiscal stimulus, okay? And it's not because of the reasons that he's publicly stating, you know, which is like he's trying to take a stance of fiscal responsibility. The reason Ishiba is currently pretending to be some fiscal hawk is it's simply because his opposition had already dove headfirst into doing that, and so he has to oppose the opposition by default, lest he appear to simply just copy it and thereby endorse the other side's ideas, right? This is a man with zero actual ideology other than his personal obsession to remain in power as prime minister, okay? So, despite Ishiba, okay, opposing cutting consumption taxes and all that, long-end JGB yields just still kept climbing up throughout May and all that. And perhaps it's JGB markets that are reflecting an Ishiba or an LDP further loss. Either that or they just straight up don't believe Ishiba and his hawkishness and his fiscal responsibility or whatever, okay? But it's at this moment when 30-year yields are like pressing hard up against that 3% ceiling, that's when the prime minister says his now very infamous, very stupid quote heard around the world, quote, "Our country's fiscal situation is undoubtedly extremely poor, worse than Greece's." Worse than Greece's, okay? So that, I'm sure you might have heard that headline of the fucking Prime Minister of Japan comparing the fiscal state of Japan to Greece's. And by the way, he's technically not wrong. It's actually worse than Greece in terms of debt to GDP. But what do you know? Yields on JGB 30s finally punched through that 3 handle right there when he said that, okay? Now, Ishiba's stupid comment of Japan being in worse fiscal shape than Greece, that wasn't what had actually spiked long end yields to, record highs through the 3-handle. And I'm going to get to that play-by-play in a moment, okay? But the reason that I'm mentioning this clown and this comment is because it's important to note that this guy made this completely unnecessary comment when bond markets were teetering on a knife's edge, and then he fucking basically pushed it over the edge, okay? So either Ishiba has like zero understanding or awareness of the precarious state of where bond markets are, or he had some idea but didn't care and said what he thought would be politically expedient personally, which it wasn't anyway. Either way, it's important to know that Japan's current prime minister doesn't seem to know of or give a fuck about government bond markets and sovereign borrowing costs, which is quite extraordinary, because supposedly global leaders and political incumbents everywhere are, at least to some degree, being like, quote unquote, governed by the bond markets, right? Even Trump. But Ishiba is a guy who literally isn't aware of or isn't following the so-called Liz Truss moment that everyone else is. Albeit to differing degrees for everybody. But, I mean, look, if anyone needs to know about market-governed deficit spending, it should probably be the leader of the world's most indebted nation. The one that's worse than Greece, right? So, if you think that the answer to reining in higher JGB yields is like higher JGB yields impact on self-interest of incumbent government, think again. That doesn't exist in Japan. So let's just run through quickly what happened in long-dated JGB yields and long-dated US Treasury yields in the back half of May and start of June, okay? So, May 20th, the day after Prime Minister Ishiba's Greece comment, the Ministry of Finance held a 20-year JGB auction that resulted in the worst auction results in decades. And upon the results of this horrendous auction coming out, 30-year JGB yields surged some 20 basis points intraday to all-time record highs and now blasted right through and well into that 3% handle. 40-year JGBs are also hitting all-time record high yields upon this as well. But that also pushes 30-year US Treasury yields upwards and through the 5% level, okay? 30-year US Treasury yields moved sharply higher during Asia hours. Now, a day later, the US has their own 20-year Treasury auction that didn't go so well, though not nearly as disastrous as some of the commentary at the time was making it out to be. You had stronger than expected participation from foreigners, from indirect bidders. So much for that, like, dumping America narrative. But nonetheless, that kept 30-year US Treasury yields yielding a 5-handle for the course of the next week. That is until just one day before another long-dated 40-year JGB auction. The Japan Ministry of Finance, in collaboration with domestic and international financial media, headlines, but they start sending out surveys to JGB market participants and basically are implying or hinting at the potential for a reduction of issuance on long-dated JGBs, and 40-year JGB yields get crushed down 25 basis points, and thereby sending 30-year Treasury yields back below 5% for the first time since it had been pushed up into the 5-handle. May 28th, that 40-year JGB auction was also met with tepid demand, and that pushes up yields on JGBs, on US Treasuries, on UK gilts, and on German bunds higher. And that guy, the guy from Bloomberg TV in London, he discovers what a 40-year JGB is for the first time ever. So the bad 40-year auction that actually didn't see not nearly as big a market reaction move as the 20-year auction disaster. And that's largely because we now have expectations, expectations of either a Bank of Japan tapering coming at this June meeting, or a Ministry of Finance shortening duration of issuances coming in this like kind of impromptu bond market feedback meeting that they scheduled a few days after the Bank of Japan. Okay. But due to this kind of speculation that supply on the long end of the JGB curve is going to be reduced either by less issuance or by tapering that long end by the Bank of Japan. Because of that, the remaining JGB auctions don't see nearly as much of a volatile swing upon their results coming out. Okay. Nonetheless, though, June 3rd, 10-year JGB auction, that one actually was met with some better results, and that therefore continued to once again pull 30-year Treasury yields down even further away from the 5% handle. And then finally on June 5th, a 30-year JGB auction results come in weak once again, but I guess it wasn't as shitty as feared and stabilizes DM long end bond yields. And so if you knew of none of this happening in Japan and you were simply looking at US Treasury long end yields in isolation, then you would be just making up one narrative, irrelevant narrative explanation after another during this entire time, right? And many, many, many out there are doing just that, all right? And by the way, that's a very, very good thing that I welcome for us because we can exploit people's ignorance. But the simple reality is that long-end U.S. Treasury yields were moving on JGB price action, and JGB price action is a function of JGB auctions and matters of JGB supply and demand headlines and activity taken from Bank of Japan as well as the Ministry of Finance, okay? All of these global yield moves during this time frame were driven by JGBs and Japanese officials at MOF and at BOJ on expectations to stem the rise in their long-term borrowing costs, and that spilled out into treasury markets, okay? Basically, almost none of this price action and volatility at the U.S. long end was happening due to, U.S. domestic matters. All right? Again, just ask Secretary Bessent. Or just look at the fucking charts. It's very, very evident, okay? So, now that we've established that JGBs have been in the driver's seat for global sovereign bond markets, we now need to take a deep look into who and what is behind the actual JGB yield moves. Who are the key players and what are they doing, okay? And the answer to that might surprise you for two reasons. Number one is that it was actually foreigners who had been buying a record amount of long-dated JGBs. That's right. Foreigners were long JGBs. Not the Widowmaker trade, it's the opposite. And then at the same time, the always reliable bid in cash JGB markets, Japanese life insurance sector, they were conversely net sellers. Okay, so you have foreigners buying JGB long end, and we have domestic insurance companies selling at the long end. And this is another thing that I get more into depth in my Substack in terms of what the actual positions or trades, positioning structure that each of them had deployed that they essentially got blown up in. One of them is an asset swap, in which you buy a 30-year JGB and you are swapping that fixed coupon rate for a floating one using interest rate derivatives, 30-year rate swaps, and that kind of constructs something that resembles a floating rate 30-year JGB instrument. Those got blown up, and you started seeing massive gaps in the rate swap spread and 30-year JGB cash yields. And again, that's just another function of just very messed up markets. All this is going to be in the corresponding Substack that I keep referring to throughout this video. The link is in the description if you want a more detailed look into what actually moved the bond yields, global bond yields around via the JGB markets. Just take a look at the minutes from the most recent bond market group meetings held by the Bank of Japan, where they collect feedback on bond market conditions. These are meetings that were held between May 20th and May 21st, and they were released on June 2nd. Quote, in the super long-term zone, supply and demand conditions deteriorated markedly and interest rates rose significantly. This led to the unwinding of asset swaps and flattener positions triggered by the announcement of U.S. tariff policy, while structural market change has also been taking place in terms of reduced demand from life insurance companies. Regarding supply and demand conditions in this zone, attention should also be paid to the impact of investor speculation over fiscal policy. Now, I want to be very clear about the key premise of why JGB is the most dangerous market in this current juncture. This is not because of Japan default or credit risk. Okay? Let me repeat that. The JGB market is not a dangerous market because of a sovereign default risk in Japan. At least not for the moment, and that's not why I'm identifying or characterizing it as a danger. Okay? JGBs pose a major threat to markets and to the economy because of the reasons I had listed earlier, right? But namely because of this unreconcilable supply and demand imbalance currently underway, combined with severely damaged market functionality and the incredibly delicate and difficult task to have to balance these issues by authorities at the Ministry of Finance and the Bank of Japan without breaking sovereign bond markets. Okay, so let me break that down. First of all, when I say that it's not like a matter of Japan's sovereign debt default, but rather a supply versus demand imbalance of long-dated JGBs. So one might say that that's the same thing, right? There's too much debt outstanding, there's not enough buyers. That's the definition of an inability to fund, which leads to not being able to service outstanding debt, and then there comes default, right? Yeah, okay, fine. I get that, and what I'm saying is that those are not equivalents of one another. When I say supply and demand imbalance, I'm talking about the literal quantity of JGB pieces of paper out there and the inability or incapacity or unwillingness for markets to absorb that outstanding quantity of supply. But that does not mean, therefore, default, okay? A default is a failure to make interest or principal payments in full and on time, right? And as massive a pile of debt as Japan has, Japan is not defaulting on its debt, at least not unless they choose to for whatever reason, because debt defaults are by and large not done by choice. Rather, a default occurs when the debtor has no other choice, just cannot make payments anymore because the funds have been just depleted faster than they can be replenished, right? That's not a risk scenario that Japan currently faces because JGBs are issued in yen, and the Bank of Japan can and has been and will continue to backstop the government as the buyer of last resort, if not the buyer of only resort. Even if those coupon payments or principal repayments are being made with currency that is completely worthless, those worthless JPY denominated payments can and will always be made, okay? I know that Japan default is a very sexy narrative and one that is certainly circulating within Japan market chatter of what is currently underway with long-end JGB yields. And I also know that there are many people out there almost wishing for such an event to occur for whatever reason. But a technical default is not on the horizon for Japan, okay? Just think about it practically. Default means you're not going to get your money back that you lent out. Okay, you're not going to get paid back. So if that really is what's being priced into markets, does a 30-year JGB yielding at only 3%, does that really reflect that kind of credit risk profile, sub-US risk-free rate on 30 and 40-year JGBs? No, okay? Even the 250% debt to GDP ratio, does that figure make sense, economic sense? It really doesn't. Okay, 250% debt to GDP shouldn't really ever exist because on the way to 250, it would either have to be reversed back down via drastic spending cuts and massive revenue, tax hikes, revenue increases and all that, or a default on the way up to 250. But the fact that Japan has been able to just maintain above 200% debt to GDP for the past several years means that Japan default or its inability to pay just simply isn't the scenario or an action that needs to be taken. Perhaps any other country, normal country, wouldn't be able to normalize sitting north of 200% debt to GDP, but Japan has and has been and therefore has no reason that it can't continue for now. Okay, again, of course the currency can and has been and likely will continue to get destroyed, but JGB coupon payments will be made for the foreseeable future. So again, what are we talking about? We're talking about literally too much supply of JGBs, too little demand from markets. Okay, Ministry of Finance issues ever more JGBs flooding into the market with supply. And then over the past several years, much of that supply has indirectly been bought up by the Bank of Japan, such that it amasses half of the outstanding JGB supply on its balance sheet via QQE, yield curve control, effectively monetizing the debt as we just went through. So what's the issue now? Why can't the Bank of Japan just keep buying JGBs? What's the problem? Okay, this is where the rubber meets the road. This is why this moment is different and dangerous. Okay. Because since last year, July 2024, Bank of Japan began to taper its JGB buying. Now, why? Why are they doing that? What's the reason for this? It's not because of inflation, okay? And it's not because the policy worked. It's because the Bank of Japan's JGB buying actually hit a limit. And that limitation is market functionality, or the lack thereof. Okay, that's the limitation that apparently now governs Bank of Japan's JGB buying. Okay? When you own half of outstanding JGBs and are severely distorting market forces and natural pricing mechanisms by literally setting hard stop lines in the sand via yield curve control, and you're offering to buy unlimited quantities of JGBs and end up owning 100% of certain issuances and all that kind of thing, when you basically have that kind of scenario and you intrude in markets at that level, then you impair and you destroy the existing normal market infrastructure. You destroy trading liquidity. You see critical market participants like market makers and ARBs disappear from the ecosystem. You have futures markets and hedging instruments completely malfunction and are basically rendered useless. You have days that go by where no cash trades are made in cash JGB markets. You completely reshape the behavior of how markets operate. And you replace it with some new norm that resembles nothing else out there, okay? You have yield curves shaped completely non-economically, right? Weird little kinks here and there. And you distort fixed income pricing and trading, that whole complex, okay? And you eventually have a literal non-functioning market as a severe side effect of this experiment in extreme easing. And that's what the Bank of Japan had accidentally created, and that's what the Bank of Japan is limited by, and that's what the Bank of Japan is currently trying to fix via its tapering, okay? In fact, they can't even effectuate easing anymore because of market dysfunction. This is what lifting yield curve control bands higher starting in December 2022 until removing it altogether, that's what that was all about. They didn't lift yield curve control upper trading bands higher in order to tighten policy. They did that so that they can continue to effectively continue easing, okay, which they could no longer do due to market dysfunction. Okay, so that's what the dilemma is. That's what the dangerous tightrope is, okay? If the Bank of Japan reverts back to full-on QQE and JGB buying, if they taper their tapering, then they dig themselves further in the hole of market dysfunction and eventually won't be able to even do their QQE as usual, okay? But if they continue tapering, then they reveal what true market demand, absent BOJ and absent the knowledge of the BOJ backstop being there, is, okay? And what they're finding out is that demand is almost non-existent. Okay, not to mention the higher borrowing costs for the government. But again, that's not the immediate problem. The problem is, once again, too much supply of especially long-end JGBs versus too little market demand to mop it up, and a very dysfunctional market in and of itself. Okay? Take a look at the very first paragraph of JGB issuance plan from the Ministry of Finance debt report. Quote, Japan has the worst fiscal conditions among major developed countries, including outstanding general JGBs estimated about 1.10 blah, 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 blah. Okay. It is getting more important for the Japanese government to adequately implement JGB management policy to secure the market's stable absorption of JGBs. That's what they said. It's not Japan will default and we need to get our fiscal house in order. It's management of term structure and to accommodate the market's absorption of JGB supply. So why is this dangerous to the global market, picture? Because of two direct reasons in the immediate to near term, as well as for years going forward, as long as this is going to continue. First is what I've been saying. The higher long-dated JGB yields breaking new record levels means higher long-dated US Treasury yields. And higher US Treasury yields actually do have material consequences to markets and to the real economy and to the government and to budget policy and to the Fed and so on. Okay, so there's that. The second risk is also one of market illiquidity and functionality outside of Japan. The US Treasury market, which is supposed to be the largest and most liquid market in the world, right? And I suppose it still is, relatively speaking. But that doesn't mean that the US Treasury market is as deeply liquid as it once was or is perceived to be, okay? Because we're increasingly seeing erratic market swings and volatile behavior in cash US Treasury markets and episodes of sharp swings and blowups occurring with greater frequency. March 2023 comes to mind when 2-year US Treasury yields moved a full percent in a week, had some of the largest intraday swings on record. Veteran macro hedge funds who thrived in market chaos and volatility going back into the 90s had simultaneously blown up and shut down in March 2023. Okay, this is due to markets that are supposed to be relied on to be large and liquid and stable and easily transactable, but when volatility hit, those characteristics were no longer so and blew up in further extreme volatility and unmanageable price swings such that macro hedge funds had to shut down, okay? And this isn't just a cash JGB and cash US Treasury problem. This is in DM government bond markets worldwide. This Liz Truss moment, the real one, the UK LDI crisis moment of forced deleveraging by pension funds, okay? But that's also long end gilts that showed themselves to be far less liquid and stable than had been expected, such that the Bank of England had to step in with emergency yield curve control, bid for unlimited long end gilts to stabilize the situation, and doing so in the middle of a hiking cycle at that, okay? We're seeing this everywhere. We're seeing this in DM, government bond markets everywhere. This is what happens when non-economic central bank whales have enormous market presence in their respective government bond markets and then leave those distorted footprints behind, okay? And the more intrusive the central bank, the more dysfunctional that market becomes. And nobody has been more free market destroying than the Bank of Japan and the JGB market. And currently underway is an attempt by the Bank of Japan to taper out of the JGB markets and reveal what they have done to them, okay? This latest episode of global market dysfunction and extreme price volatility we just saw in April and May of this year. What we saw in bond markets was not some pure, deliberate reaction to Liberation Day. Everyone talks ad nauseum about this incredible phenomenon of when U.S. bond yields went up, but the dollar declined, and thereby showing foreign investors fleeing U.S. assets. Fine, maybe some did, okay? But no, not really. That was also yet another bout of extreme price volatility and illiquidity, okay? Do we not remember that yields initially plunged in the actual immediate reaction to Liberation Day before reversing higher? Everyone just talks about the yield move higher, but without including the context of U.S. yields first plunging before they reverse higher, you're left with only a story about yields moving higher rather than the full picture, the full context of yields moving higher being a reversal of yields first plummeting, okay? So, back to the world's most dangerous market, JGBs. JGBs are extremely illiquid, and they are broken. And it doesn't take much to move long-dated JGBs and have them break out to new record highs. The Bank of Japan is attempting to taper. The Ministry of Finance is attempting to jawbone a twist in duration. Any slip-up or unforeseen pocket of illiquidity that only reveals itself in real time can trigger a sharp move in global bond markets. And it may be to the upside and it may be to the downside, but either way, it will be received by the public as an upside move, and that has implications not just on market volatility, but policy volatility. Japan needs someone to fill in the shoes of the Bank of Japan. There aren't shoes big enough to do so. So what comes next? June 17 Bank of Japan policy meeting. This is a meeting that happens to be the one that's set out since the beginning of tapering, any changes that are coming and all that kind of thing. And the second is a few days later on June 20th when you have the Ministry of Finance who's holding impromptu meetings with primary dealers to get feedback on guidance on how the Ministry of Finance should term out the JGB issuance. Okay, essentially, Japan officials gave themselves an extra mulligan shot after the June BOJ meeting on whatever happens or doesn't happen with that. Okay, so that's what's been happening in the JGB markets and US Treasury markets. If you want my personal assessment on how I think that this is going to play out in the upcoming 2 catalyst states and beyond, as well as more depth and detail on trades and structures and all that, and once again, just go to my Substack for those insights and more, and support my work at Across the Spread. And if you found any of this to be of any value, please hit the like button for me and follow the channel so that I can get an idea of what to do with like video content going forward. And as always, thank you for your time, and we will see you soon.